Have you ever been cruising down the highway and suddenly found yourself stuck behind a brand new truck that costs more than most people's homes? You know exactly the one. Blinding chrome finish, leather interior that probably runs more than your monthly rent, and a payment that would send your mortgage lender into a full panic attack. And here's the part that really gets under my skin. The person behind the wheel probably brings home less money than you do. So what is actually going on here? And more importantly, stay with me on this, because by the end of this video, I'm going to show you a number so alarming that it completely reframes what you think you know about how Americans are handling their money right now. My name is Nick, and I spend a borderline unhealthy amount of time thinking about money and why people make the financial decisions they make. Hit subscribe and drop a thumbs up if this one opens your eyes. Now let's get into it. Because the first thing I need to show you before we talk about how people are pulling this off is exactly how bad the numbers have actually gotten. And I promise you are not ready for this. The average new car payment in America has crossed into territory that would have been called completely unhinged just a decade ago. We're talking monthly payments that beat what a lot of people hand over for rent. And yet millions of Americans are signing loan documents every single month and driving off the lot in vehicles that cost more than the median household earns in an entire year. Now here's where I need you to really pay attention, because most people assume these buyers are secretly loaded. They're not. They're teachers, nurses, mechanics, retail workers, office employees, regular people with regular paychecks who somehow made the numbers look like they work, or at least convinced themselves they did. There is an entire system built specifically to make impossible payments feel possible. And once I walk you through how that system operates, you will never look at a dealership the same way again. But first, let me give you the raw numbers, because when I share these figures, people almost always think I'm stretching the truth. The average new car payment has climbed past $700 a month. $700. Not for an exotic sports car. Not for a loaded luxury sedan. That is the average payment on a regular new car purchased by a regular American. But it gets uglier when you zoom in on trucks and SUVs, which have become the default choice for most buyers in this country. Those payments routinely clear $900 a month. And payments pushing past $1,200 are not rare. $1,200 every single month for 6, 7, sometimes 8 years. We are talking about payments that stack up to more than $80,000 across the life of one loan before you have spent a single dollar on insurance, gas, or maintenance. Now you might think wages have gone up enough to justify these numbers. And if that's where your head is, I genuinely hate to be the one to tell you this, but the data says otherwise. Median household income has nudged upward, sure, but nowhere near enough to support these payment levels by any traditional financial standard. So how are people doing it? The answer lives inside a combination of factors that have quietly and completely changed how Americans buy cars. And none of these factors are good news for the person signing the paperwork. Let's go through them one by one. First, loan terms. And this one is foundational to everything else I'm going to show you today. Remember when a car loan was 3 years? Maybe 4 if you were really pushing it? Those days are as dead as the flip phone. Today's car loans routinely stretch 6, 7, or 8 years into the future. Some lenders are even dangling 10-year car loans in front of buyers, which honestly sounds like something ripped from a financial horror script. The appeal is obvious on the surface. Spread a $60,000 truck over 8 years instead of 4, and the monthly payment drops significantly. Suddenly, that truck that would have demanded $1,500 a month on a 4-year loan starts looking almost manageable at $900 over 8. The monthly number looks reasonable, and that is exactly the figure the buyer locks onto. But here's what most people never stop to think about while they're sitting in that dealership chair. And this is the part most salespeople are really hoping you skip over. Stretching the loan term doesn't just lower the monthly payment. It dramatically inflates the total amount paid. That $900 payment over 8 years adds up to over $86,000 compared to roughly $72,000 on a 4-year loan. That is $14,000 extra dollars paid purely for the privilege of a lower monthly number. And it gets worse. They will still be making payments on that truck long after the truck is worth a fraction of what they financed. Cars lose value fast, especially in those first few years. By year 5 or 6 of an 8-year loan, they'll owe significantly more than the vehicle is worth on the open market. Stuck in what's called negative equity. Unable to sell, unable to trade without writing a personal check just to break free. And I need you to hold on to that phrase, negative equity, because it becomes the engine that drives everything I'm about to show you next. Extended loan terms are only the opening act. The second major factor is the explosion of 0% financing offers. Walk into any dealership and you will be greeted by signs shouting 0% APR for qualified buyers. Sounds incredible, right? Basically, free money to drive home something brand new. Here's what those dealers are absolutely counting on you not figuring out. 0% financing is not free money. The cost of that deal is built directly into the price of the vehicle. You are either paying full sticker and getting the 0% rate, or you are negotiating the price down and paying market interest, but you do not get both. And those 0% offers almost always come loaded with tight credit requirements and shorter loan terms. The buyers who actually qualify are typically the same people who could have paid cash and walked away. For everyone else, interest rates on these extended loans can be steep, especially when the credit score isn't perfect. Then there's the trade in game. And this one is where things start getting genuinely dark. Here's how it plays out. Someone finances a new car on a 6 or 7 year loan. 3 or 4 years in, they are tired of it and ready for something newer. But they still owe more than the car is worth. So what do? They roll that negative equity straight into a new loan on an even more expensive vehicle. This creates a cycle where people are perpetually paying for cars they no longer own while simultaneously taking on brand new debt. Their loan balances keep climbing even as they make payments every single month. It's a financial hamster wheel where the faster you run, the further behind you fall. And here's something the dealership definitely doesn't put on the window sticker. They love this arrangement. Once someone is caught in the negative equity cycle, they become a captive buyer for every new model that rolls onto the lot. Breaking free would mean writing a check for thousands of dollars just to get out clean, and most people will never do it. But before I get into what this actually costs people over a lifetime, I need to tell you about the psychological piece of this puzzle, because this is the part nobody in the automotive industry wants talked about openly. The most alarming trend in all of this is not the loan terms or the interest rates. It is how completely normal these extreme payments have become. People who would never in a million years agree to spend $1,200 a month on anything else somehow convince themselves it is a perfectly reasonable transportation cost. Think about it this way. If a friend told you they were spending $1,200 a month on coffee, you would sit them down for a serious conversation. If they admitted to dropping that amount on clothes every month, you would assume there was a real problem that needed addressing. But when it is a car payment, everyone just nods and says, well, you need reliable transportation. This normalization did not happen by accident. It is the result of decades of precision marketing designed to convince Americans that their vehicle is a direct expression of who they are as a person. Your truck is not just getting you to work. It is a statement about your character, your hustle, your standing in the world. And if you are not driving something impressive, well, what does that say about you? The auto industry has become terrifyingly good at triggering these exact feelings. They are not selling cars anymore. They are selling identities, aspirations, and social status. That commercial showing a rugged truck conquering mountain terrain is not pitching you transportation. It is selling you the feeling that you are the kind of person who conquers mountain terrain, even if the most off-road you ever go is parking on the grass at a local county fair. This emotional machinery makes it remarkably easy for people to rationalize payments that would otherwise sound completely irrational. When you are not just buying a truck but buying into a version of yourself, that $900 payment starts feeling like an investment in your identity rather than a financial anchor dragging you backward. And speaking of anchors, let me show you exactly how people are restructuring their entire lives to keep these payments going. Because this is the part that genuinely stunned me when I first started researching this. People are not just budgeting around these car payments, they are rebuilding their entire financial lives around them. I have seen people move into smaller apartments or stay in roommate situations way longer than they planned just to keep their dream truck payment alive. They will eat cheap every day for lunch while commuting to work in a vehicle that costs more than some people's first homes. They will skip vacations, cut restaurants completely, and delay every other major purchase, all to protect a car payment that is consuming 25 to 30% of their take-home pay. Some people have picked up second jobs specifically to cover vehicle costs. They will drive for a rideshare service or run food deliveries on weekends using that same expensive truck to generate the income needed to keep paying for that same expensive truck. It is a strange closed loop where the vehicle becomes both the burden and the only way to carry it. Others are raiding retirement accounts or borrowing against their 401k to cover down payments or repair bills, borrowing from their future selves to fund their current taste in trucks. And since most people genuinely have no concept of what early retirement withdrawals actually cost long term, they have no real awareness that they might be trading away hundreds of thousands in future wealth for something that will be worth practically nothing in 10 years. Then there is the credit card shuffle. People putting maintenance, repairs, insurance, and fuel on cards just to free up cash for the monthly car payment, using high-interest debt to prop up their transportation budget. It is a bit like using a blowtorch to light a birthday candle. Technically functional. Terrible idea by any measure. The most concerning pattern I have come across is people pulling home equity to cover down payments or roll over negative equity from a previous vehicle. They are leveraging their homes to buy cars, which gets the entire purpose of both assets completely backward. Your house is supposed to build wealth over time. Your car is supposed to move you from one place to another as efficiently as possible. When you start using the former to fund the latter, the math is working against you in a way that compounds every single year. But here is where the story gets even more layered. And I want you to stay with me here. Because what I'm about to get into is something that almost nobody is talking about openly. Many of the people making these extreme sacrifices are not doing it for one vehicle. They are doing it for two or three simultaneously. The average American household now owns more cars than it has licensed drivers, which is an impressive logistical achievement and a financial disaster dressed up as convenience. 2 or 3 simultaneous car payments inside a single household is not unusual. Dad has his work truck, mom has her SUV, maybe there is a third vehicle for a teenager or weekend use. Suddenly, the combined car payments inside that household dwarf what most families pay for their mortgage. These families have built their own personal auto financing operation, except instead of generating revenue, it hemorrhages money every single month, while the inventory depreciates towards zero. And here is the psychological effect of managing multiple car payments that nobody ever talks about. People become genuinely skilled at juggling due dates and minimum payment amounts while completely losing sight of the bigger picture. They will celebrate paying off one loan while signing 2 new ones in the same week. They measure success by their ability to keep all the plates spinning rather than asking whether the plates needed to be spinning at all. Now, I also want to touch on something most people wildly underestimate when they are doing the mental math in that dealership. Insurance. Insuring a $60,000 truck costs dramatically more than insuring a $20,000 sedan. Stack on comprehensive, collision, gap insurance, and all the coverage a reasonable person should carry on an expensive vehicle, and you are looking at premiums that can easily clear $200 a month. For households with multiple expensive vehicles, that number can push toward $500 monthly. That is $6,000 a year just for the legal right to drive depreciating assets on public roads. Most people are so focused on negotiating the monthly payment that insurance does not even enter the conversation until they are sitting across from an agent getting a number they were not ready for. And then maintenance adds another layer of reality that catches people completely off guard. Modern trucks and SUVs are complex machines. When something breaks, and something always eventually breaks, the bills can be genuinely shocking. A routine brake job on a current generation truck runs $800 to $1,200. Transmission problems can land at $5,000 or higher. Serious engine work can push past $10,000. Most people making extreme car payments have no emergency fund to handle any of this, which means the repair goes on a credit card or becomes another loan, which adds another monthly obligation on top of everything already stacked up. You will see people with spotless $70,000 trucks sitting in their driveways while they are stress checking their bank account for gas money. It is like owning a Rolex while surviving on ramen. Impressive to look at. Completely missing the point. And fuel costs alone on these trucks can approach what people used to pay for an entire car payment a decade ago. 15 miles per gallon in real-world conditions. With gas bouncing between $3 and $5, a gallon translates to $400 a month or more for a normal daily commute. Add a road trip, and that number climbs further. But now I want to run the actual math on a real scenario, because this is the part most people in a dealership never sit down and calculate. And once you see these numbers laid out completely, I think it is going to reframe everything we have talked about today. Someone buys a $55,000 truck on a 7-year loan at 6% interest. Monthly payment lands around $800. Feels manageable compared to the $1,200 a shorter term would have demanded. Over the full loan, they hand over roughly $67,000 in total payments. Insurance at $250 a month adds another $21,000 over 7 years. Fuel at $350 monthly stacks on another $29,000. Maintenance and repairs over that same period will comfortably run $15,000, likely more. Total cost of transportation over 7 years, north of $130,000. And at the end of those 7 years, the truck is worth maybe $15,000 on a good day. They paid $130,000 for the experience of driving a $15,000 truck. That is not transportation financing. That is wealth destruction with a moonroof and heated seats. Now here's the number I want you to sit with, because this is the one that I promised you at the start of this video that would completely change how you see this. If that same $800 monthly payment had gone into a basic index fund earning 8% annually, the account would be sitting at over $70,000 after 7 years. No loan. No depreciation, no insurance premiums on something they do not fully own. Actual wealth quietly building in the background. That is the real cost of the truck, not $800 a month. $70,000 in wealth that will never exist. But here's why people still do it. And this is the psychological piece that makes this cycle almost impossible to break once someone is inside it. After committing to extreme car payments, people develop what I can only describe as automotive Stockholm syndrome. The truck stops being transportation and starts being a reflection of their identity, their hard work, their success. The thought of stepping into something cheaper does not register as a smart financial move. It registers as giving up, accepting a lower place in the social order. This emotional attachment makes clear, rational thinking about money almost impossible. When someone suggests they could free up hundreds of dollars a month by driving a dependable used vehicle, they do not hear sound financial advice. They hear a personal attack on their self-worth and their right to enjoy what they've earned. They will defend that truck payment with the same energy they bring to protecting their family, even when that exact payment is what is preventing them from actually securing their family's financial future. The industry understands this psychology better than most people understand themselves. They have spent billions mapping out exactly which emotional buttons to push and how to turn those feelings into loan signatures. Walk into any dealership and notice what almost never comes up in the conversation: total cost of ownership, opportunity cost, long-term wealth impact. Every conversation circles back to the monthly payment, the right now experience, and what this vehicle says about you as a person. The entire sales process has been engineered to neutralize every rational objection before it can fully form. Payment too high? Stretch the term. Worried about reliability? Here is a warranty you can finance. Nervous about depreciation? Don't even think about it. You'll probably want to upgrade in a few years anyway. So there it is. The mystery of how people are affording these payments is not a mystery at all. It is a carefully designed system of extended terms, emotional manipulation, and financial gymnastics that would genuinely impress a circus performer. People are not actually affording these payments in any real sense. They are pushing the consequences further down the road while convincing themselves they earned the right to that shiny truck. Next time you pass someone piloting a vehicle that costs more than your house, just remember they are probably eating cereal for dinner to keep up with it. And maybe, just maybe, that sensible used car sitting in your driveway deserves a little more respect than you have been giving it.